The headline number was very noisy. There was a significant hurricane effect. The Labor Department said it. There was weakness in the most weather-dependent sector. So I think it was actually a decent headline number when you add that back in, probably. Maybe it's worth 50, 60,000 or so. And then there were some big upward revisions to prior months and a strong household survey. So overall, it's a very solid report.
And in terms of immediate reaction, looking at the note you guys just put out, you have increased your tracking number for GDP for the quarter.
Yes, that was more driven, we're now at 3.3%, that was more driven by the international trade report, which showed a somewhat smaller widening of the deficit. So that's more a mechanical thing. The jobs report, though, says that, away from the kind of month-to-month or quarter-to-quarter GDP tracking, the labor market is very solid.
And it confirms your expectations and forecasts for Fed rate hikes for this year and next year?
Yes, it's very much on track. We're expecting a hike in December and then 4 hikes in 2019. So that's still somewhat more than market pricing, despite the recent sell-off in the bond market.
The headline inflation numbers, Jan, have seemed so benign and in line with what the Fed is expecting. Is there any concern on your part that perhaps these government numbers are not really telling the full picture when it comes to inflation? I mean, we are seeing higher oil prices. We are seeing higher interest rates. We are seeing wage increases. I mean, Amazon just increasing its minimum wage to $15 across the board from seasonal all the way to full-time employees. Kevin Warsh referred to this in his interview with Squawk the other day, saying that he thinks that it's actually running hotter than what the government numbers show. What do you think?
Well, the headline inflation numbers are above 2%. Core inflation in the Fed's preferred measure is 2%. That's the core PCE index. And I think, no number is perfect, but I think that's a reasonable estimate of the underlying trend. We have seen an increase in oil prices. That matters, but it is unlikely to be as persistent as other components of the inflation indices. So, there's not just one reality. There are lots of different realities, and I think it does make sense to focus on core PCE as a measure of the underlying trend. That said, 2% is higher than where we were. We were down at 1.3% at the bottom in 2017, so we're now at the Fed's target. Not a problem. Wouldn't be a problem if we went, somewhat above that. 2.25%, let's say. That's our expectation for next year. That's consistent, I think, with a symmetric 2% inflation target, but it's also consistent with the Fed continuing to hike rates, and probably by more than what markets have been pricing.
So is the 10-year 100 basis points higher a year from now?
We don't have it going up that much, but we still have it rising, and mainly because we think the market's still underestimating how high the funds rate's going to go and how sustainable that increase in the funds rate is going to prove. I mean, it's both of those things that matter for the entire curve.
When it comes to the sustainability of the Fed funds rate, why are you positive on that?
Our general view has been that the certainty that the neutral funds rate is as depressed as many people in the market have been saying for the last several years, that's misplaced. We think that the reason why we had an extremely low interest rate environment in the last decade is primarily that we had a big crisis, big recession, and hangover effects from that recession that took a long time to disappear, but now we're in a different environment, I think.
Normalization, essentially.
Yeah, normalization and a somewhat more cyclical kind of pattern to what happens with interest rates. But sometimes these cycles can be very extended. So this has been a very, very extended cycle. But I think a lot of what we've seen has still been cyclical rather than necessarily structural.
Are international yields going to be dragged higher as well or not? And what does that all mean for the US dollar?
Well, I think they have been dragged higher, obviously. If you just look at what's been happening in the markets, in the short term, you should always expect quite a lot of spillover. Longer term, I think it depends more on the economic situation, say in Europe or in Japan, vis-a-vis the United States. The US is much further advanced in the cycle. There's a very solid case for the Fed to be, maybe a little more hawkish than they have been, and what markets are pricing. But there's much less of a case for that in Europe. European inflation is still 1%. Unemployment rate is much higher. Japanese inflation is even lower. So central banks should focus on, doing the right thing for their economies, and that's a very different interest rate environment in these different economies.
Is there a yield at which you start becoming concerned about the impact when it comes to corporate profits and corporate profitability? I mean, when you take a look at what corporations have borrowed during the easy money cycle and where their credit ratings are and where that debt may adjust, you start getting worried?
In aggregate, not necessarily, because they're winners and losers from higher interest rates. So I think the direct effect of higher interest rates on corporate profits in the aggregate is not going to be that large. That said, higher interest rates are partly a symptom of being pretty advanced in the economic cycle. We're not forecasting a recession anytime soon, but clearly a lot of the cyclical improvement that we're going to see has happened. The unemployment rate was 10%. We're now below 4%, and while we think we're still going to come down further, most of this cyclical improvement, which has also been boosting profits and helping the equity market, is at this point behind you. So it's a tougher environment at this stage in the cycle from the equity market perspective of the equity market than where we were 5 years ago, let's say.